See, so the question then is, where are we at now? So right now, we have a PE of 18. Well, we have inflation of 8. That equals 24. So that means to get down to 20, the stock market has to drop this to 12. So that 12 plus 8 equals 20. Well, that would be a 17% decline. So the market would have to go down 17% from today to have a PE of 20. Okay, so right now the market is, based on current inflation rates, market is 17% overvalued. Now, a lot of people believe that inflation will go away on its own, that it'll just float into space. But it doesn't work that way. Historically, it doesn't float into space. It has to be rooted out. It's like termites in a house. It starts going and it's painful to get it out. And historically, you have to reduce the money supply. You have to raise interest rates, which puts us in recession, which kills demand, and that resets the clock, and it causes inflation to come down. And so the second thing to a stock price, you've got PE, that's the first one. PE times earnings, how much the company's making, and that gives you the price of the stock. It's interesting how simple it is. Beginning of the year, the PE was 24. The earnings were about 200, and so recall the price, just do the math, was about 4,800, I think. And now the PE earnings have stayed the same. So all the declines that we've experienced year to date is merely the PE going from 24 to 18. That doesn't sound so bad, does it? But it's been pretty painful in the market. Now the earnings is the second component. And if you look back to 2000, what you'll see that there's these two trend lines. You have the upper trend line and the downtrend line. And you'll see earnings kind of came down in the year 2000 recession. They recovered. And then in 2008, they went through the floor. They recovered and kind of did this. And then we had the 2020 recession. And then the stimulus checks went out. And it went up like this. Okay. And so what you do is, if you look at the pullback in earnings here, and you look at the pullback in earnings here, exclude that one. That was a bad one. That was like a 93% decrease in earnings in 2008. The banks really took a hit. But if you take these two and you average the amount that earnings declined in both of those, it was 40%. And what's interesting is, if you take a 40% decline from here, my scale isn't perfect, but it's close. It'll take you right down into that long-term trend line. And so in a recession at this point, if we, when we have a recession, we could see a 40, that would just be an average decline in earnings, kind of on the light side actually. And then if you have a normal contraction in PEs, you would see, you put those two things together and you have a really dramatic decrease in prices. I almost hesitate to tell you where the math comes out, but it comes out to about 1,500 on the S&P. And I don't want to say that that's going to happen. I don't know if it'll happen, but I want to be protected against it happening. And so right now in a bear market, it pays to be careful. If you look at bear markets over previous bear markets, they tend to be driven historically by that inflation process. If you look at the 70s and the 2000s, what you'll notice is it's hard to tell the difference between the two of them. You see a sell-off, you see a recovery, and then you see a deeper sell-off, and then you see a recovery. And they both have two recessions, and the second sell-off is worse than the first sell-off. And if you look, before you get that sustained recovery, in the 2000s it took 13 years, and in the 70s it took about 10 years. And so that's a bear market where it's flat, it's down, you get a lot of choppiness, sell off up, until you finally get what's called a capitulation, where you just get a big sell off and everybody's given up, and there's no more sellers and there's only buyers at that point. And you can start more of a sustained recovery on the way up. And so in a bear market, what you just need to be a little more active. You want to try to protect against these downturns as best you can, and you want to try to capture these upturns as best you can, and then protect the downturns and capture the upturns. So the key is to have a process that can do that. And so we've done, what we did in August is we put together a strategy that should be able to capture, prevent at least 80% of the downside and capture, the goal is to capture about 80% of the upsides of these. And so there's 3 core strategies that we have to do that. The first one is pretty simple. The first one is bonds. So instead of owning bond funds, we're owning individual bonds. You just buy a bond, and 3 months later, it matures. You know, we got another one, we do 6 months. Here, we've even got one that goes out 1.5 years. And we just buy the bond, pays an interest rate, it matures. And they're all high quality, short-term bonds. So there's only 2 types of risk with bonds. There's interest rate risk, the risk of interest rates going up, and there's default risk, the risk of companies going bankrupt. By buying short-term bonds and holding them to maturity, we get rid of the interest rate risk, and buying high-quality short-term bonds, we very much minimize the default risk. If you have a high-quality bond and it's short-term, the chances of it going bankrupt in the next 12 to 18 months would seem pretty low. Like, is PerkinElmer going to go bankrupt in the next 18 months? Doesn't seem like it. But we still diversify. We only put 10% in. And so the idea is, as long as we hold it to maturity, we're going to make money, and it's guaranteed. Right now, the overall yield is about 4 to 5%, and that should trend up as interest rates continue to go up. The second strategy is the long-short strategy. And that's where, when the market indicators point towards negative, we want inverse funds. Inverse funds go up when the market goes down, okay? And they're not things that you want to hold long-term. They're just things that you want to hold while there's negative momentum in the market. And so we've got multiple technical indicators that show positive or negative momentum. They're not perfect, they don't work every day. They tend to catch kind of the longer term trend, and then when it turns around, it takes a couple days, and the indicators change, and it allows us to restructure a portfolio. So since August 15th, we've been short the market, where we've been making money as the market goes down. As of today, we are removing the shorts, and we're at a pivot point here. Will we get a little bounce, or will it continue back down again? And we don't know. So we're just in a neutral position right now, neither long nor short, just cash. And we're waiting for the indicators to show us, are we going to have positive or negative momentum? If you look at the market big picture from the year, it's come down, it ran up, it's come down, it ran up. This was March, this was June to August, it came up. There's been this long-term trend line right here, and it went above it actually a little bit in March, and then it kissed it in August, and it's been coming down. There's another trend line down here. It's not there yet, but it's very possible that we run back up in the short term for a little bit, and then come back down again. We don't know. We're kind of right there, and so we just kind of want to take a wait and see again, protect and grow. If we don't know, we just want to be neutral. We'll wait for confirmation, and then we'll either go, we're invested so that we make money on the way up, or on the way down. And until we have more idea, until those indicators flip, we're just going to take a wait and see. So that's the long short. The idea is make money on the way down, make money on the way up, make money on the way down, make money on the way up, make money on the way down. And it's not equal. So that what it should look like, and we've back tested it over many time frames. When the market's headed down, the goal is that we maintain, maybe with a little bit of growth, and then when the market heads up, grow like this, and then when there's downward, kind of grow like this, and then when it heads up. So this, if only I could guarantee such a thing, right? But this is what we're trying to do. The third strategy that combines with this one is value momentum. So we're looking for stocks. We have research that shows the stocks that have an intrinsic value higher than their market price, and their sector is in favor. And so things like you've seen in your portfolio, things like Kroger, General Mills, ExxonMobil, Energy. We believe in the midterm, while it could be volatile, it could be longer term, it could be attractive. And so the base portfolios, we have 60% of stocks allocated towards this, 40% towards this. And in August, we reduced, instead of being, so that this could be 100% stocks or less. We reduced it in August to we had about 75% of that. 40% was in stocks and the rest was in cash. Yesterday we reduced it to 50%. Before the news of the United Nations asking the Fed to pause came out. So we just want to remain flexible. So if we get a confirmation to buy, we'll ratchet this back up and try to take advantage of a long term. I doubt we'll ever be at 0% on this one because it's a midterm investment. This one is more short term. The long short's more short term. The value momentum is more of a midterm investment strategy. We're trying to find companies that can do well over the midterm, but they may be down in the short term. So we do want to absorb and be sensitive to kind of the directionality of the market and look and have cash for good long-term buying opportunities. And so we're able to kind of ratchet this portfolio to be more risk on, neutral, or risk off. And the goal would be, even if the market's doing this, we're kind of doing this, right? And we really reduce the volatility, create consistency, and make forward progress even in a really, really difficult, long-term difficult market. And bear markets tend to last a long time. So in the last 12 to 18 months, we've been really restructuring the systems, the processes, the indicators, the actual investments, our resources, our research, everything towards this type of market so that we're prepared for a massive sell-off. But if we don't get one, we can ride the markets up as well. Okay, so it's just much more active portfolio management and risk management against a catastrophic market decline. That's what we're really concerned about now. And at the same time, we want to find opportunities to grow. So we have other opportunities like private equity, private real estate, which we think are really good additions to these three strategies. And we're also using alternatives, which I won't get into today, but they can also make forward progress in a difficult market. And so everything that you've seen in your portfolio has been managing these three strategies towards this type of market. And so please don't hesitate to let me know if you have any questions, if you have any thoughts. I'm doing the best I can. My team's working really hard to do the best that we can. Every trade is an incredible amount of work, but we really want to manage that risk for you and also find the opportunities for you, help guide you through this, and then customize it to your needs and who you are as a person and your financial plan. So as you know, we like to have quarterly meetings, and we're happy to adjust the strategy and customize it to you. But this is what we've done as a baseline for people just to cause that protection. And again, since August, stocks have gone down. The stock indexes are down about 17%. The bond indexes are down about 4 to 6. And the baseline portfolios are down less than 1%. And so that's been good. Now we're going to neutral just in case these start to recover. And we want to try to ride that up too. So, and then in all likelihood, there'll be another sell-off. And so we'll probably take a piece of that sell-off and then try to do that. So far, so good, but it's your money. You hire me to help you with that. And I want to do everything that I can, including the education and sharing with you what we're seeing and why we're seeing it and what we're doing about it. Thanks so much.